been over a year now that we've been doing these webinars. I think this is probably our 9th or 10th webinar that we've done. And thank you to everyone who dials in and listens to what we have to say. The initial concept of these webinars actually took place at Laurium before COVID struck, and the idea was just to let potential investors and existing investors into our boardroom to give them to share some of the insights that we have, some of the discussions that we're having, but also the idea is to introduce the broader Laurium team to the investment community. So I'm joined here today by Rob Oelleramann, who's been with us for roughly 6 months now. Rob was a founding member of Tantalum, and when Tantalum joined us 6 months ago, Rob and a few of the Tantalum folk joined the team. And then out of our Joburg office, I'm hoping that Dwayne Dippenaar will turn on his camera at some point, and you'll be able to see Dwayne, who is one of our equity portfolio managers. There he is, the ugly smiling mug of Dwayne Dippenaar. He's one of our equity portfolio managers and one of our equity analysts, and has a real passion for Naspers. And given that Naspers is such a big component of a number of our portfolios, Dwayne is going to run us through what I would hope for a lot of you is a reminder of the Naspers and Tencent investment case, and for some of you, just give you some insights as to why we like the stock so much. Just on 100 people dialed in, and I think a lot of people would have been on our webinars previously. But just to remind you of how we do things. We will apply for CPD points, so there is some educational benefit that we put into the presentation so that you can get those CPD points. I'll highlight when that comes up, and we encourage you to ask questions at the end of the presentation by putting it in the Q&A using the Q&A button. And we will ask you 3 questions over the course of the presentation and share the results with you, just to give you a feeling as to the way that the market is being viewed. So I thought I'd just reintroduce the Laurium team to you. There haven't been any major changes since our conversation that we had back in January. We've had a couple of new joiners, and then I just wanted to sort of highlight where Rob and Dwayne, who we've got on the line, fit into the picture. So it's a big team of just under 30 people, split between Joburg and Cape Town, as you can see between Dwayne and where we're sitting in Cape Town at the moment. I thought what was a good thing to do is look at what we said back in January 2021, and whether the points that we made at that point in time are still valid now, or if they're not. And I'm actually quite happy to say that most of the points that we made, I think, have either come to pass or are still valid. But let's go through them, what we said then, and ascertain whether they're still valid now. The first one was that we felt that global equities are a better place to be invested than global fixed income. And I think with the returns that you've seen out of the US markets, and I think global equity markets relative to fixed income, that has come to pass and continues to be the way we believe the markets will play out for the next rolling 12 months. The second one was that we indicated that we thought that global fixed income yields were expected to be predominantly negative, and asset allocators would have no alternative to invest in equities, the so-called TINA trade. And that has come to pass, and Rob will run you through later on in the presentations just what the yields look like in the US, and they still maintain that negative real yield bias. We continue to favor value over growth. There actually hasn't been that much in it this year, but there's probably 2-3% in value versus growth, and we think that continues over the course of the rest of this year, with last year's winners expected to underperform some of the real economy stocks. It didn't perform that well last year. Look, the jury's still out on that. Rob and I were talking earlier today. Apple reported last night, and it's certainly one of those big growth stocks that has absolutely shot the lights out in terms of earnings. And Rob will run you through some of what's happened in the earnings space in the US markets. The Rand adjusted returns from global equities are pretty similar to the returns for domestic equities. Actually, that's come to pass. There's not a huge difference in rand terms between the returns that we've generated in South Africa relative to global. Probably a little bit better in South Africa than we'd initially anticipated, and that'll probably continue into the course of the next 12 months. And then we said that the broader indices like the S&P look fully valued. Well, I guess that it did. It still looks fully valued to us, so we've given it a tick, although it's up 10-11% this year already. And then if you look at the EPS growth prospects, I actually looked this morning at what the market's forecasting for the S&P. The 2021 number is now greater than 30%. It's 33% growth from 2020 to 2021. And then the 2022 number, which we said we thought was looking a bit punchy, has come down to over 15% growth, to around 13% growth into 2022. So I've given us a tick next to that box as well. And then finally, we said that the COVID vaccine rollout in the first world would see some form of normality return in the second half. I think that's probably still on track. I listened to parts of Joe Biden's speech last night, and I think he's indicated that he said at the beginning of his presidency, he wanted to get vaccines into the arms of 100 million people. They've done over 200 million people now. And talking to a mate of mine in New York over the weekend, he was saying that if you're over 16, you can just basically walk in and have a vaccine done. So we're getting to that point of some normality returning. One of the big things that we said is we expected the dollar to weaken. And in our asset allocation meetings, which Rob is a very integral part of, we've had large debates as to whether we got this right or wrong. I did the numbers this morning, and I looked at whether the dollar did weaken against the DXY, which is the trade-weighted index of currencies that we look at the US dollar versus, and the euro. And actually, it's strengthened 70 basis points since the end of the year. So since beginning of the end of last year, beginning of this year. So I've been quite critical of our marking and say that we got that wrong so far, but it's early days, and we do believe that the cyclical argument of the USD as a counter-cyclical currency will continue to weaken the dollar over the course of the next 12 months. And I'll give you some reasons as to why we think the dollar has held up relatively well, given the broader themes that we had in mind. We said that we thought there'd continue to be fiscal and monetary stimulus in first world economies. That, if anything, has exceeded the expectations, the amount of stimulus that has come through. And part of this is as a result of the blue wave. At that point, we didn't know if they were going to win both houses, and that has obviously led to a far bigger amount of stimulus coming through into the US economy, and also in the European and other developed economies. And this is one of the other things that we think will lead to dollar weakness over the course of the next 12 months. The flip side, and this is very much was mentioned in Biden's address that I listened to last night, is the taxes are likely to go higher, probably likely to go higher for higher earners and for companies that have been given big tax breaks by Trump. So there are numerous proposals out there. If anything, the direction of travel from a taxation perspective in the US is upwards, we believe. And then finally, the threat of inflation. I think I spent quite a bit of time listening to the press conference after the federal FOMC meeting last night, and listening to what Chair Powell had to say about inflation. He's still very much playing it down. You'd know that the US has moved from a pinpoint inflation target to effectively average inflation. And he's saying, look, we averaged under 2% inflation for a long time. We can go over that 2% inflation for a reasonable amount of time without us needing to react. We're not worried about inflation at this point. There are some other market commentators that are more worried than the Fed about inflation. I'm probably in the bucket of worrying a bit more than Chairman Powell is about inflation at this point in time, and it's something that we spend a lot of time looking at and debating within our asset allocation committee.
Let's just run one of our polls quickly. We're going to ask you a quick question around when you feel it's likely that the Fed is going to raise rates. If you don't mind just popping in a quick answer there, you can choose one of those four, and then we'll flick over to the next slide where you might get a view from our team.
Okay, so while you're considering that, I thought I'd show you the FOMC dot plots. Now, a lot of people talk about the dot plots. But I did a little bit of poll survey, a few colleagues that work at Laurium, and tried to understand if they actually knew what the dot plots meant. And it might surprise you that there were a few that actually had no idea how to interpret the dot plots. So this is where the education benefit comes in, and this is what gets you your CPD points. So here's the teacher coming out to me. My grandmother was a teacher, so maybe that's why I'm keen to do it. You'll notice in 2021, you probably can't count them, but there are actually 19 plots that have been plotted along the 2021 line, and then 2022, 2023, and then longer term. Each of the members of the Federal Open Market Committee, the FOMC, is surveyed ahead of the meeting as to where they expect rates and various other things to be in various time buckets. So at the end of 2021, at the end of 2022, at the end of 2023, and they submit those forecasts. You can then, they make it public after the meeting. So what I've displayed here is what happened at the meeting that took place on the 17th of March, and then they put out the data. The interesting thing to me, and when I first looked at it, I wondered why there were 19 dots, because there are only 12 members of the FOMC. But what happens on the FOMC is that there are seven members. There's the chairman, which makes up 8, and then there's a rotating 4 seats that make up the remaining 12 members, out of 11 of the different federal banks. And because of that rotation, that rotation happens on an annual basis, those guys that are not on the FOMC now could well be on the FOMC next year and the following year. So the dot plot take into account not just the guys who are actually voting at the FOMC, but also the guys that could potentially rotate on. The bottom line with this is that the members of the FOMC and those that are going to rotate on don't see any reason for rates to rise beyond where they are at the moment to the end of 2023. So we've got a long time from here, at least 2 years before rates start to rise. And if I listened to Chairman Powell yesterday, in addition to these rates that are going to continue to be very low in the US for a long period of time, there is no intention to start tapering the asset purchases that they're doing. So monetary policy in the US, and I think in the major developed markets in the world, is going to maintain a very accommodative stance for a long period of time. And that is one of the reasons that we think that the dollar can remain weak. Mike is showing you the end of the result of the poll there. So most people saying end of 22. I certainly voted later than 2023. So I'm in the minority in the 9%. What this chart is showing in the red line, I'm sorry, the lines are a little bit small on your screen, is the US versus developed market GDP growth forecast. So you've seen this huge increase in expected growth in the US relative to other developed markets. And I think it is that huge increase in growth, and Rob will talk to it a bit later, it's that huge increase in growth that has given support to the dollar. But these factors that we believe that we're going to weaken the dollar, being that the dollar is a counter-cyclical currency, that when you get growth, the dollar tends to weaken, that is still in place. And it's just been this huge delta in growth between the US and other developed markets that has maintained the dollar's relatively strong position. So we do continue to believe that the dollar will weaken over the course of the next 12 to 24 months. One of the things that's kind of keeping me up at night, and I would think it probably is keeping a lot of you up at night as well, is what's happening with this dreaded third wave. The map on the left-hand side basically shows the average daily cases per 100,000 people that have been registered in the last week of COVID. And what you'll notice is that South Africa down at the bottom there is an absolute aberration. Everyone else, even with the vaccine programs being rolled out, over 1 billion vaccines are in the arms of people already. There is this unbelievable second or third wave, depending on which country you're in, that is continuing. You'll see from the graph on the right-hand side that I pulled out of The Economist. The Economist put this publication out last night, that yesterday we registered the highest number of COVID cases since the start of the pandemic. Yet we operate in South Africa in this almost little vacuum that there is hardly any infection at the moment. And it's something that worries us. We discussed it on our morning meeting today as we're looking at one of the hospital companies' results. Is there a third wave coming? Does the third wave come? Have we all got immunity, or what is going to happen going forward? And this is something that we continue to worry about and discuss significantly. I'm sure everyone's got views as to what might or might not happen. I certainly am still fairly uncertain. So I'm going to hand over to Rob now. Do you want to drive the slides, or I'm going to pull for you?
Will you just
I'll do it for you. Okay.
Thanks.
So Mike's going to just run a quick poll as to when you think that the cyclical trade that's been in play, how long it'll last. Is it going to last? Is it over? It's got 6 months to go. Can it go for more than a year? Or we think we're in a super cycle. So submit your votes. Rob's going to give you our view on that now, and then we'll release that at the results at the end.
Thanks, Brian, and good morning from my side. It's really nice to be part of this team, thriving culture of lots of interaction and great deal of intellectual stimulus. I've really enjoyed being part of the Laurium team for 6 months now. Actually, it's gone really quickly. Whenever we talk macro, I get a little uncomfortable, even though it's kind of almost the day job of an asset allocator and someone that does multi-asset funds as I do and as we do as a team. There's always a little bit of a kind of bad taste in the mouth when you think about macro forecasting, looking ahead, because it really is you're setting yourself up to fail. And yet I think, as Brian has demonstrated in the introduction, that there's been a good track record of success in the past, and in the recent past we've had a really nice run of macro foresight. And I think just at this point I'd say that I think that the trends are still strong enough in general for us to have conviction that this cycle still has legs to it. And that's almost cutting to the chase before I get to the content of my presentation. When we've had the kind of run that we've had in markets, I think you all would have enjoyed the same beta that everyone has. This first quarter has been another strong quarter in risk markets, and it's always tempting to, particularly when we've had such a shock like we had in COVID last year, you want to take money off the table immediately. And I would kind of caution against that, and want to take you through a couple of slides which will maybe just give pause for thought on cutting too soon in this trade. The first one is the slide that's up in front of you now. I was just talking about the US GDP growth. I mean, US is still, we talk about the US as if it is the world, but it is still the dominant economic engine in the global economy. And it is particularly well placed for growth. I, in my sort of 20 plus years in the market, it's seldom since I've seen this degree of conviction around US GDP growth that we see now, and it's admittedly off a low COVID base, but with the blue wave and in the post-Trump era, I mean, aren't you all relieved that you don't wake up every morning thinking, what did Donald Trump tweet last night? I think that the world, there's definitely a few basis points at least of risk that have been taken off right across the globe without that Twitter feed. So I think the blue wave has been a big contributor to this. And if you look at this chart here of US GDP forecasts, you can see the steps up that we've had since Biden came in, that staircase on the right, the light gray line. What hasn't really budged is the view on 2023. I think part of this is a reflection of just a lack of appetite to go too far ahead of the curve on the part of forecasters. But I think if you look at the fiscal stimulus that's still being baked into the US economy from the Biden administration, and this talk of the infrastructure investment that is still to come, that number is, I think, quite sensitive to those expectations. And that's where I think we might start seeing some upside in US forecasts going forward. So bullish in the short term. The other tailwind, which is, I think, a very underrated and neglected part of the puzzle is this picture around inventories. And you can go back to, you look at when the red and black line crossed after the 2008 financial crisis, and you saw the surge in orders cyclically after that, and yet inventories have gone low. This is even more extreme than that. The COVID environment really has separated supply chains east and west. Trade has been very narrowed over that time period. Inventories are low. I follow a lot of global industrial companies, and there we have seen some, significant forward order building in real world economies. And this trend, I think, is going to make 2021 still a surprising year for everyone. So that's still another one on the bull case. And then the third one really is the excess savings that have been built up. A lot of consumers, individuals, and even businesses have been able to save actually through the COVID pandemic, not traveling as much. The discretionary spend was actually initially slow, and we're starting to see a nice buildup of savings. And this is what's giving the consumer a push. And even consumer companies are beating right across the board. So I think that's another pent-up part of this puzzle, which is giving us conviction that the cyclical recovery is not over yet.
And it's not just a US story. I mean, if you look at it, the US has been the biggest story of it. 7% excess savings is the Bloomberg estimates. But you can go across most developed market and even China, you've got these excess savings that are built up. There's this huge amount of cash that is sitting in bank accounts ready to be spent.
If we look at what that has done to company earnings, so this is S&P 500 as of yesterday evening. Out of 500 companies, 197 have reported. And the average beat is almost 12%, or around about 12%. And it's right across the board. Obviously, energy is the blowout where the earnings surprises from a year ago when oil was obviously in the depths of despair. That trade has rebounded strongly. But you can see right across the board, earnings at company levels, even in this quarter, have continued to surprise on the upside. And that's where we've seen the upgrades. And we still think that there are upgrades to come. Brian alluded to the fact that the S&P forecasts for 21 have gone from over 20 to over 30%. The companies that I'm looking at and analyzing on the global side, I still see a lot of room for upgrade. And we are seeing some big beats in these numbers, again, as we saw last night with Apple, with Google the day before, a whole raft of consumer companies, and even the financials as well. So the banks are beating now too. So those are all very positive signs for the market to continue this cyclical rally. Where's the negative surprise? Well, I think on the bond yield side, and this is perhaps the most important slide in the pack from my perspective as an asset allocator between equities, bonds, and cash. The inflation expectations, the gray line here, have surged. And there's no doubt we've seen it in metals prices and in goods prices. We're also seeing it, obviously, to some extent, picking up in services inflation. And so, as Powell spoke to yesterday, we moved to above 2%, and we're getting closer to the sort of 2.5% break-even inflation being baked into market expectations. What we haven't seen much of is the red line move, and that's the risk indicator. That's the real rate in the US, and that is still negative. And that's what is keeping the equity, keeping the risk on trade still in place. And I think that'll, we see upside in that number. We think that this is way below normal in terms of discounting by the market of the known and unknown risks out there. We would expect that to go up, and we think that's why bond yields in the US, for instance, it's 1.61% US 10-year Treasury yield. We think that has upside because of that red component there. We think that the red line continues to track higher as markets kind of factor in a normal level of uncertainty, a normal level of risk, and the potential for the Fed to taper their $120 billion per month asset purchase program and to start tapering that. So that's where the market will get jumpy if that jumps too quickly. Pardon the double jump. Translating this view back into South Africa, it's important to keep us back to home.
So we just had the results shared there Rob, so it seems that most people are in agreement with our view that could go on for some period of time. So, and even some super cyclers out there. So that's good to see.
I think it is, every cycle will be different, but they often rhyme, and you've got to look at these indicators that I've highlighted for you today. I think that the tailwinds are still strongly in place. South Africa, do US yields matter? Yes, they do. Look at the correlation between the moves over the last little while, and we will show you, or we will definitely have shown you charts in the past of how important the US Treasury curve is to the South African bond yields. If we move on to the next slide, though, we have seen an improvement in the situation in South Africa. The budget deficit was marginally better than what we saw in the MTBPS. I think while we still are at excessive levels of debt to GDP here, I mean, let's face it, it's not a comfortable position for our fiscus. The reduction in the weekly auction sizes is very welcome and has taken some of the heat out of the yield curve, certainly at the long end. I think if we move to the next slide, the kind of known unknown is the fact that most of that improvement that we saw in the fiscal position came from forecast spending cuts, and in particular around the wage bill, the public sector wage bill. We all live in the real world here and know that the implementation risk around that is high, and the political will to deliver that ambitious target, I think, is possibly open for test. On top of that, we've still got the SOEs, which remain a concern right across the board, stating the obvious. So our fiscal position remains a concern. However, if you look at the long end, we've got a very, very steep yield curve in SA. And if you look at that red line at the bottom here, which kind of indicates the steepness of the yield curve, the difference between the long end and the short end, we really are baking in a lot of concern and risk in terms of longer term fiscal weakness in the risk metric. So that's pricing, I think, a lot of that negativity that we've seen. So if I just were to summarize on the next slide, we do think that the US bond yields have upside, mainly on the real side. There is some anxiety over inflation, but that for us seems to have been priced in the TIPS market. Of course, what is bond supportive is the fact that this good global growth environment, which we expect to continue for this, certainly for this forecast period, is positive for EM spreads, it's positive for risk assets, including South Africa. And so we should see our spreads staying intact. Within South Africa, I don't think inflation is something that we should be complacent about. But having said that, there is quite a large buffer within the target range. And with, we will see food inflation picking up like we've seen overseas. But I think the inflation risks look within bounds of forecast. And then, of course, as I mentioned, the fiscal position is unambiguously weak, but it has got slightly less weak, if I can call it that. So really the conclusion for me is on the long bonds, they offer a very compelling pickup in bond yield over sitting in cash at the moment, 10% versus 4.5%. And that steepness of the yield curve offers quite a strong buffer against sell-offs that periods of risk will bring. And if you kind of stack up a range of outcomes, cash against bonds over the next 12 months, even with some sell-offs, we think it favors bonds. So we've been increasing our bond weightings and increasing our bond allocation and duration in the recent past in this sell-off, partly at the expense of some equities, and then also with cash, our least preferred option over this time period. I think the all-in bond trade, SA structural growth, it's too early to call that. High key man risk. President Ramaphosa, I think sometimes looks like he's fighting a battle on his own within the ruling party. high key man risk, and the structural growth impediments within South Africa are still quite significant. So it's not an all-in trade, but we're definitely starting to move some money into bonds.
Thanks, Rob. I'm going to run through a brief view on what we're thinking about equities, and really just call out some of the changes that we've made. The people who've dialed into this often are familiar with this slide. There are a few changes that we've made since we last spoke. Growth in South Africa, I think when we last spoke, we were looking at about 3%. We think that you could push it to 3.5% if we're lucky, but still slipping back to around 2% in 2022 and 2023. We've moved our US 10-year view. We were at 1.5%. We've moved that to 2%. A lot of people have asked me, when does it become uncomfortable for equities, the US 10-year? And I think our conclusion is sort of 2.25%, 2.5% is when things start to become uncomfortable and when we start to get reasonably nervous. In terms of South African rates, we had thought that there might be the opportunity for a further cut this year. We've kind of changed that view now. We think within the next year or so, you've probably got the chance of a 25 basis point hike. Probably not in 2020, not in 2021, into 2022 is when we think that hike would come through. And then on the 2030, or actually we think more about the 2031 now being a 10-year bond, we think 9% is about fair. And that's why Robbie is saying that we have been pushing both the allocation to bonds and also the duration position that we have. We left our currency view as it was, 15.50 on the rand. Obviously, it's a lot stronger at the moment. It does have potential, as we all know, to move around quite significantly. Oil also a lot stronger at the moment than the 55, but that's where we think it will end up 1 year out. So how do we look at the SA equity position? We think that there are a couple of things that are actually reasonably supportive for South African equities. Firstly, the global factors. Rob's talked about the low and negative real rates and the support that gives. He's talked about the fiscal stimulus that's taking place in the US and other markets. I've talked about the weak dollar, which we think favors emerging markets, favors South Africa as it comes to pass, and also favors commodity prices. Weak dollar results in strong commodity prices. And then emerging markets are back in favor. This is a chart that I pulled from JP Morgan earlier in the week that tracked the flows into emerging market. The gray line, the shaded area, are the flows, and the blue line is the MSCI Emerging Market Index. And you'll see these record flows going into emerging markets. As the dollar weakens, as growth and that cyclical trade that you all voted on takes place, emerging markets are big benefit factors of it. The local factors that should buoy the local market is it's the end of real returns from cash. So what I've plotted here is your 3-month NCD. You can look at it as basically your with the cash that you receive on deposit at a bank, and the South African CPI. And you'll see that the gap that your clients had back in the day, where they could sit in money market funds and beat inflation, that's gone. If they sit in money market funds now, inflation is going to eat their retirement for breakfast. So they just cannot afford to do that. They need to be in risk assets in order to drive returns. We're starting to see a resumption of dividends post the COVID crisis, and some buybacks taking place. A number of companies that I cover have recently done buybacks. That is positive for the market. And then, look, we hope to see some positive developments on reform, corruption. We all have been watching the Zondo Commission, sometimes with some humor. We had some good humor watching some of the responses yesterday. I hope that the progress continues to be made there. And then just to remind everyone, we've got a very diverse local JSE market. You can invest in resources, you can invest in domestic South Africa. It's not all about domestic South Africa. It's actually mainly about not what goes on in South Africa. And we're able to find some very interesting companies. Dwayne is going to talk to one of them shortly, but that we're able to generate returns from. I've historically showed you this chart, and I couldn't avoid it. This is our index that we make of the South Africa Inc., the heartbeat of South Africa, the companies that just operate and have their earnings driven by South Africa. They're looking reasonably cheap, but factor in that weaker growth that I mentioned. So the 3.5% GDP growth this year, 2% the next couple of years. You're paying just over 11 times earnings for it. We think that's fairish value at the moment. So we've got to find opportunities within the South African domestic market, or the SA Inc. basket, rather than just buying the overall basket. And we are able to find some pockets of value, which I'll show on this slide. So where we position, actually, we haven't changed the portfolio positioning in equity significantly since I last spoke to you. We still maintain our position in global consumer. British American Tobacco, they actually had the AGM yesterday. It hasn't been a great one for us this year. It looks very, very cheap, trades on sort of 6-7 times earnings and an 8% dividend yield. Naspers, I'm not going to cover on this slide because Dwayne's going to hopefully do an excellent job of it in the next couple of slides. The healthcare stocks, I said we were debating this morning, we've had a couple of results through from the healthcare stocks, and what you're starting to see is in this gap, say between the second wave and the third wave, you're starting to see the elective surgeries come back. People that have kept, put off the surgery on their hip or whatever the case may be, those are starting to come back and are really starting to add value for these hospital stocks. And you're able to buy them at very attractive multiples. So we've built a basket of hospital stocks that we own in the portfolio, and we think that those earnings will start to come through as normality returns. In the financial space, we still like banks, but we prefer insurers. And the insurers are some of those in the crowd that have got dividends playing again. You've got very good cash flows coming out of these, out of the South African financials at the moment. And then within the resources space, we've kept on the cyclical trade. We own a combination in our funds of the diversified mining stocks and the platinums. Those who follow some of the underlying commodities, we're talking about it again this morning in our morning meeting. Iron ore sitting at unbelievable highs at the moment. I think 190. Copper through the roof. Platinum, palladium, rhodium. Rhodium just keeps on powering ahead. So it's the cash flow that these guys are spitting out is unbelievable at the moment. And we think that there's legs, as Rob said, to the cyclical trade. You've got to dance close to the door. It's not going to last forever. You've got to watch very carefully. But for now, we think that there's good legs in the cyclical trade in South Africa. So Mike, you're going to put up a survey. So Dwayne's going to give you the answer to this. So the question is, what percentage of mobile internet estimated, give your estimation, in China is on Tencent's platform? So is it less than 30%, between 30 and 40, between 40 and 50? And remember, there are numerous platforms. Just to give you a clue, there are numerous platforms in China. Tencent has got one of them, but there's Alibaba. There's all sorts of different platforms that people can use on their mobile devices. So think about that as you give your answer. So I'm going to hand over to Dwayne now, who's going to talk firstly about Naspers and then about Tencent.
Thanks, Brian, and good morning to everyone online. If we look at this first slide here, what we've got here is Naspers' discount to its net asset value. So you can see it's traded, it's been relatively volatile over time as management have tried to unlock that discount. But right now it's trading close to 50%, which we would say is way too wide. So basically that implies that if you look at Naspers' underlying investments and you fair value them, those investments are worth well more than the full Naspers market capitalization. So we think at 50% discount, Naspers presents a very, very attractive entry point into great internet assets. Of all the internet assets Naspers owns, the largest by far is a company called Tencent in China, which makes up about 85% of the intrinsic value of Naspers' underlying investments. So we're going to dive deeper into Tencent, which is a large and complicated company, but just quickly look at why we think Tencent is still, firstly, a very attractive company and still looks like a great investment at this point. Firstly, Tencent is the largest online community in China, and it was started with something called QQ, which was like an MSN messenger, and they built out from that and entered many verticals where they were definitely not the incumbent, but managed to actually gain market share through having this large online community in QQ. They also now own something called Weixin, which is basically the WhatsApp of China, and they've got over 1.2 billion users on that, of which about 1 billion is in China, so 1 billion out of the 1.4 billion people in China. And through that, they've gone into many other verticals within the internet. So really, Tencent, besides being the WhatsApp of China, is also the largest social network in China with something called Q Zones, the Facebook of China. It's got the largest news network in China, the largest video platform that would be the same as Netflix and YouTube, the largest music platform similar to Spotify, and all the IP for a lot of music they own into multiple music companies globally, like Universal. They're the largest literature platform in China, and that's exciting because they own a lot of IP, Chinese IP, and they started to take that IP and make games with it and movies with it. And I mean, in the last results call, they've actually discussed creating the Disney of China, which could be another great and exciting opportunity. And then they're the largest online mobile payment platform in China. So you can see their reach stretches across multiple platforms. And if we put all those platforms together, it's estimated about 50% of the mobile internet traffic in China goes through one or other Tencent platform. Now you can imagine, if you call that data the new oil of today, the amount of data they are able to collect on all their users from multiple different platforms and put that together. And that puts them in an extremely powerful position when looking at creating products and creating revenue off their platforms. On the back of that, you've got the largest internet population in the world, over 1 billion people already in China. And we know there's very, very strong per capita income and growth in China, which is supporting that. We've got growing internet penetration. China is only at 72% internet penetration versus the US at 87%. Still great growth there from a penetration perspective. We've seen proliferation of low-cost smartphones. So smartphone prices have come down dramatically. And if you look at the big Chinese telcos, like China Mobile, they're rolling out 5G and 4G aggressively, putting huge amounts of money behind that. And that should help smartphone penetration in China, which is currently at 71%, grow dramatically compared to the US at 90% already. So big tailwinds behind the internet and internet growth in China, which Tencent should also benefit from, which is great. The great thing, and what Tencent has done very well, is taken this platform that they use and all this data they generate and basically identified new internet companies that are doing very well and getting traction. They're then able to go and take capital they generate and invest in those internet companies. And Tencent has actually now become the biggest venture capital company in the world, with a portfolio of over 800 companies they've invested in, mostly in the internet space. And of those, only 60 have listed to date. So they've deployed over $80 billion into this portfolio. And that portfolio today is worth over $300 billion. So they've generated over 60% IRR on that portfolio, which is exceptional. So that portfolio, which generates no income for the company at the moment, so it's not included when you look at its PE metrics, is worth about 1/3 of Tencent's market cap at this stage. And that's, I mean, I'm taking, of the 800 companies, I'm only taking the 60 listed at their listed price, and all the other companies I'm taking at their cost price. So there could be a huge amount of value that can still be unlocked there. That being said, I mean, while Tencent's a big and growing company at the moment, there are still massive monetization opportunities in new internet verticals for Tencent. Payments, they've only just started monetizing, and they're the biggest mobile payments platform in China. Wealth products, they already have over $100 billion invested in their wealth products, and that's only a start. And that's an industry that's really underdeveloped in China, so huge opportunity there. Software as a service, they would say that's their next big avenue of growth. And that's really providing software services to various businesses in China. And they're going into that space quite aggressively. You've got online to offline payments, which they're going after. And then cloud, which they're the second biggest provider for after Alibaba in China. Health, which was helped by the COVID pandemic. And they've gone into that area aggressively. And EdTech, which is also a massive opportunity. So these are all areas they've gone into, and many of them they dominate, and they're not really monetizing at this point. So big opportunity there to monetize going forward. So, I mean, if you put that all together and then look at the valuation of Tencent versus, let's say, global peers, on the face of it, it looks like it's trading, let's say, on a 34 PE. But if I were to take off the value of all those associates, and I think it's a conservative value, which is about a third of the market cap and generating very little income for the company, then it's trading more like on a forward P of 20, which looks extremely attractive compared to its peers in China and global peers, which trade on between a 20 and 30 forward P. And the big difference here is you've got this huge tailwind of the internet growing in China and these huge opportunities to monetize across their platform, which should drive their revenue and earnings going forward. So we think you can easily get 5-year earnings CAGR of over 20%. So putting that all together, we still think Tencent is a very attractive company with a management team that has got great capital allocation or demonstrated great capital allocation. And many people would say is one of the best management teams within the internet space globally.
Thanks, Dwayne. I guess the other point to make is that you get to buy the, I'm glad to see people knew that it was over 50% to try to put them off the scent on that poll, but well done, you got the answer right. Just to accentuate the point, you get to buy Tencent at a discount by buying it through Naspers. And I think, hopefully when you listen to Dwayne, that's a similar pitch that we get from Dwayne when we're talking about whether we should or shouldn't own the stock. And you can see the excitement that he has for the stock. And I guess, it's definitely founded. And one of the reasons that we've had a kind of core position in Naspers for a very long time, given the excitement around Tencent. And we've only just scratched the surface on Tencent. There are also a whole bunch of other entities which we don't have time for today that Naspers owns that are almost as exciting as Tencent within its businesses that it owns. So hopefully that helps you give a bit of context to the ownership that we have in Naspers. I thought I'd finish up before we flick into Q&A. I'm not going to address any particular fund, but I thought it was interesting to show you is, with Rob and the team from Tantalum joining us, we've really got, we think, a fund in basically every risk bucket, so to speak, that you could potentially want to use in South Africa. So kind of just rank them from those that are more exposed to equities or risk to least exposed to equity or equity-like investments. And just the point that we're pretty complete now in terms of the fund range that we have, from very high equity to balanced funds to income funds, and across the African platform, the African continent too. And then finally, I just thought I'd give you a snapshot as to where we are in terms of fund performance. Obviously, the 1-year numbers look absolutely phenomenal. We've got to remember that we're coming off a very depressed base to March of 2020. We were in the depths of the crisis. So seeing 1-year returns for our flexible fund of 44.5%, 61% for our equity fund, which we now run on behalf of Ned Group, our high equity balance fund, which we run on behalf of Amplify, at just under 45% 1-year return. And then some of the other, I guess, less risky funds, stable at 20%, and our income fund doing 9%. But I think what we're quite proud of at Laurium is the relative ranking since inception. We realize that all of you on the board have a choice of managers to use, and are trying to pick the managers that will generate the best returns for you over time. And I think certainly the rankings for the funds that have been going for a reasonable amount of time have indicate that by and large we've done a reasonable job. Third out of the 32 funds for the flex, 23 out of 90 in the equity fund. In the big category, it's a huge category. In the balance space, we're 9 out of 132. And then even our stable fund, which is a reasonably new fund that I portfolio manage, becoming 37 out of the 129. So we're pretty proud of the performance we've been able to generate. I'll leave you with that thought, and I think we have got a couple of questions coming in. Mike, do you want to run the
Thanks for the question that comes through. We realize we have run a little bit longer than we usually do on the discussion, but hopefully it's been of great value to you. I'm going to jump to Don Skimon's question. This is for Dwayne. With the new security measures on the iOS 14.5 from Apple about data sharing, what effect will this have on the ad revenue for Tencent, Dwayne?
So I mean, firstly, we got to understand that Apple's penetration in China is very low. So, I mean, both Android and Apple's penetration in China is very low. So there are a lot of other operating systems that are used on smartphones there. So generally, it really has a minimal impact on Tencent at home in China. Obviously, globally, but it will have an impact on any sort of apps that tries to sell globally. But basically, that's very, very immaterial at this point for Tencent. And I mean, when it comes to ad revenue as well, Tencent basically dominates, let's say, the channels where it sells apps through, along with channels where it sells games through. And most of its ad revenue doesn't actually come through those channels. So it's not through app sales or game sales. The ad revenue is generated on its social networks. So things like Qzone, on QQ, and there they have both basically specific ads that they show to people and banner ads that they'll have across their news network, etc. So, I mean, I actually heard a talk by James Mitchell with the chief strategy officer from Tencent just the other day, and he was once again also reiterating that this would have sort of an immaterial effect on Tencent's total revenue within China because Apple's penetration there is so low.
Thanks, Dwayne. Another one for you from David Williams. Just your thoughts on the Chinese regulatory pressure on the tech sector.
So, I mean, this is very controversial at the moment, and we've seen the pressure on the Chinese tech stocks. I mean, starting with Alibaba, where their listing was pulled of Antpay, and then pressure on Alibaba price. So, very controversial at the moment. But one thing we've got to understand is that the Chinese regulator, first and foremost, is actually playing a bit of catch-up. So there hasn't been much regulation within that space if you compare it to other global markets. So firstly, they're playing a bit of catch-up. And if you speak to let's say you speak to Tencent, they'll say that the Chinese regulator is making sure, gauging what society thinks about the internet and putting regulations in place where society is getting, let's call it, upset with what some of the big internet giants are doing. So for instance, predatory pricing, or only allowing a certain person to sell on one platform like Alibaba was anti-competitive. So all the regulation we've seen to date, we think has been relatively logical and will actually make the internet a healthier environment for society and the internet players in China, which is positive. Tencent will say that they actually try and predict where regulation will go and be ahead of regulation, and that they've done that in the past. For instance, when there was gaming regulation with regards to kids below certain ages not being able to game, Tencent went out ahead of that and put some limits on how much people could game. So we definitely think you're going to see more regulation, and it could be negative to sentiment. But if you're going to ask me, do we think the regulation is going to come to be very negative with regards to the earnings ability of these companies, including Tencent? We would say no. It actually makes the internet a healthier place, and in the longer term creates a healthier market. The other thing to remember is, the Chinese government loves having these huge sort of internet champions, so Alibaba, Baidu, Tencent, and they've actually created a lot of JVs where the government works with them to invest in artificial intelligence. And because they can bring all their data together and they're all investing in artificial intelligence together, it's given them a huge head start within that space. And the government does like that, and having these huge internet champions, which can help with technology development. So we also doubt that the government's going to put regulation on that sort of slows that process. So while we think there will be negative news around it, over the longer term, we still think that it's not going to have a very material impact on the earnings ability of these companies.
Yeah, and then maybe one more, just with the potential growth and the upside that you've discussed, Dwayne, Naspers is likely to become even larger within the context of South Africa and possibly make our JSE even more lopsided. What's your view on that?
So yes, I mean, I think Naspers got great growth ahead of it, and I mean, the stock's going to do well. Within an asset management point of view, most asset managers now benchmark against the cap swings, where Naspers is limited down to 10%. So as it grows, every quarter it can be brought back down to 10%. So from an asset management perspective, I think it's less of a risk. I also, which we didn't discuss, I think in the medium term, there's a chance that Naspers unbundles process down from 72% to 50% in a share, which obviously means a lot of South Africans would get process shares, and you might see them sell those process shares, which would put more of the market cap within process. So Naspers' market cap will therefore decrease. I mean, obviously, if you add process and Naspers together, the overall exposure of the JSE or the cap switch to Naspers will still be large, yes.
I think the other thing on Naspers, I'm sure Rob would agree with me, is, if you look at it over the last 10 or even longer, 15 years, it has been the hugest bonus for the average retired person, the average investor in South Africa. I think every single one of us can look around the table and look at the investors in our funds and can honestly say that without Naspers, everyone would have been worse off than they are today, given the phenomenal returns that Naspers has brought to the South African market and to the investment universe.
Brian, maybe just on that point, I mean, people, that the Naspers, when Naspers originally invested in Tencent in 2001, I think they put $32 million into the investment. They actually owned 50% of Tencent at that stage. And if you work out the IRR on that, it's close to 70% from 2001. And that stake is now worth well over $200 billion. So it just gives you, a scale and a feel for how big and how well that investment has done over time for South Africans.
Yeah. And then I'll just take the last question from Mark. And Mark, thanks for your questions. We always rely on you for a few. I think you're referring to what percentage of the flows, when I refer to the EM flows into EM payments into South Africa. I think we've got slightly more flow than our natural weight in EM. So we've obviously been down weighted in EM over time as China's grown and that sort of thing. And I think we've probably over-indexed slightly on the flows. And the reason that we over-index slightly is that a lot of flows continue to go into the likes of Naspers and then also into the commodity companies that are listed here. So the huge performance of platinum palladium has really attracted some of the foreigners into South Africa. Whether we're not investing and where we're still lagging, I think, on flows from foreigners is into the pure domestic South African stocks. So the retailers, the banks, the insurance companies, those are the guys that have been at still a competitive disadvantage because they're handicapped by the relatively weak growth. I mean, look at the relativity of growth here. The US, as Rob pointed out, is going to do 6.5–7% growth this year. We're going to do 3.5%. We're getting half the growth that you get in the US market, and I think that's what sort of hampers some of the allocations to the SA Inc. component of the market.
Where there is, I think, some signs of good news there is that the outflows that were happening in the bond market last year, we saw foreigners selling out of our bonds. That has stopped, and we have latterly, only in the last couple of months, started to see foreigners returning to the bond market fairly modestly. And I think that is bond supportive, but they have not, as Brian rightly points out, within that sort of domestic equity and then within the bond space, I don't think they have had the same level of appetite. I think that still is still to come, if the cycle continues.
I think that's it for the questions. I think it leaves it just to say thanks for everyone dialing in. I appreciate that you've got lots to do with your time, so I appreciate you spending the time with us. Mike will send out the CPD certificates as he normally does, and we'll reconvene in a couple of months' time when we've got something new to share. What is your quote that you had earlier, Rob?
Rather speak when you have something to say than when you feel